A few days ago, I came across an article from Zacks titled CSX Upgraded to Buy. Here's why. I will link it down in the description. Now, whenever I see headlines like that, I'm always curious, not because I blindly follow analyst recommendations, but because I'm interested in what has changed. What happened that caused someone on Wall Street to become more optimistic about a railroad? So I opened the article, I started reading. According to Zacks, CSX was recently upgraded to a buy rating. The article points out that analysts have been raising their earnings estimates for the company. In fact, over the last 3 months, the consensus estimate increased by about 2.9%, almost 3%. The article goes on to explain that Zacks places a lot of emphasis on earnings estimate revisions. Their basic argument is that stocks tend to perform well when analysts become more optimistic about future earnings. And honestly, that's not an unreasonable argument. If investors believe a company is going to make more money than previously expected, the stock often moves higher. But as I continued reading, I found myself asking a different question. Why? Why are analysts becoming more optimistic about CSX? That's the part I think is way more interesting. The article tells us that estimates are going up. It doesn't really tell us what's causing them to go up, and I honestly don't know the answer to that. And when you're talking about railroads, that's where I think the real story is. Maybe intermodal traffic is improving. Maybe merchandise shipments are stronger than expected. Maybe East Coast ports are seeing more activity. Maybe fuel prices are helping margins. Maybe management has found new efficiencies, or maybe the broader economy is just holding up better than analysts expected. The article doesn't really explore any of those possibilities. Instead, it focuses on the fact that estimates are moving higher. And that's not a criticism of Zacks. To be fair, that's enough if your goal is simply to identify stocks that might outperform in the short term. But for railroad investors, I think understanding the underlying business is just as important because railroads are unique. A railroad doesn't suddenly become a better company overnight. These businesses move freight, coal, containers, chemicals, automobiles, agricultural products, and on and on and on. The things that happen in the real economy eventually always show up in railroad earnings. That's why railroad investors spend so much time looking at volumes, pricing, operating ratios, and economic trends. At least you should be if you're investing in railroads. What's fascinating is that a relatively small change in earnings expectations can have a massive impact on a company's value. CSX is already worth tens of billions of dollars. A modest increase in expected earnings can translate into billions of dollars in market value. That's why Wall Street pays such close attention to analyst revisions. They're not really buying the railroad based on what it earned last quarter. They're buying it based on what they think it's going to do in the future. And that's what makes the article interesting, not because Zacks upgraded CSX, but because it may be a sign that sentiment toward the railroad industry is improving. We've also seen insider buying recently at Union Pacific. Now we have analysts becoming more optimistic about CSX. Taken together, these may be small clues that investors are becoming more bullish on the railroad sector as a whole. Of course, one analyst upgrade doesn't guarantee anything, and a 2.9% increase in earnings estimates doesn't automatically mean the stock is going to just soar, but it does raise an important question. What are the people who follow the industry for a living seeing today that they were not seeing even 3 months ago? That's the question I think is worth asking. And frankly, it's a lot more interesting than a simple buy rating. Thanks for watching Railroad Economics. My name is Mark Magana. If you enjoyed this video, please consider subscribing, and I will see you next time.